Hi, I'm Stacey Hyde and I'm back with another episode of Better Financial Health in 15 Minutes or Less. And today I'd like to talk about a topic that I've been asked a lot about over the last week or so, and that is this new, it's not new, but revamped fee from the Federal Home Mortgage Association. So if you get a mortgage that's backed by Fannie Mae or Freddie Mac, you have to pay a fee based on your credit score and the amount of your down payment. This new table that they have come out with has actually raised the down payment required for some people with good credit to subsidize those with lower credit. And that has quite understandably upset a lot of people because they feel like they're being penalized for doing things right. But one thing I would like to say is, still, by and large, if you have good credit, then you are going to pay less than someone with poor credit. So what I mean by that is this fee is only one part of the cost of your mortgage. The overwhelming piece that's going to impact the affordability of your mortgage payment is your credit score and the interest rate that you're able to get. So the lenders are still going to offer you a better rate if you have a better credit score. And actually, if you have outstanding credits, generally thought of as above 780, and you want to make a smaller down payment, maybe you've always paid your bills on time, but you haven't accumulated the 20% down payment and you put down the 5%, you'll actually pay a slightly lower fee than you would have paid before. So it's really kind of a mixed bag, and you really have to dig deep into that. But if you're getting a loan that maybe your lender keeps those loans on their books, they don't just take it and immediately sell it, then you won't be impacted by this. And the thing that is going to save you even more money is not needing mortgage insurance at all, which means that you've paid down more than 20%, so you have an 80% or less loan to value ratio, meaning like if the house costs $100,000, you put down at least $20,000, then you wouldn't have to get mortgage insurance, which is much more expensive than it used to be. And we've seen some pushback on this from the National Association of Realtors, because their argument is that if people who really are not financially strong are able to get mortgages, then it could cause defaults to happen, which can cause a lot of the issues we saw in 2008 and 2009, where we had a lot of people qualifying for mortgages that really shouldn't have. And I think the most important thing to think about when you're talking about mortgage affordability is owning a home is not just your payment. You cannot just directly compare your mortgage to rent, because in most cases your utilities, unless you're renting a house, your utilities are going to be higher when you own your home because you've got a freestanding structure. The other thing that you have to understand with a home ownership is you're now responsible for the repairs. Even if you have a home warranty, I promise you it's not going to cover as much as you think it is. And so things are going to happen. The hot water heater is going to go out. You're going to need a new roof, and heaven forbid you have to replace your heating and air conditioning units. Those are super expensive things that you're not at risk for if you're renting. So when you're looking at home price affordability, yes, this fee, I would probably say it's unfortunate that it is going to cost some people with good credit more. But I think what you need to focus on bigger picture is, are you ready for the other cost of home ownership? Buying the lawnmower, getting the termite treatment, getting the pest control, taking care of just the general maintenance, because as a homeowner myself, it's always something. So I just wanted to tell you that yes, what you've heard is true. Some people with higher credit scores are going to be paying higher fees than they did before. They're not actually going to be paying less than somebody with lower credit, but the spread between what somebody with a higher credit score is paying and what someone with a lower credit score is paying, that has moved closer together. It used to be about like this, and now it's like this, which that could cost a strong borrower, $1,000 or $2,000 more. And when we're talking about fees, that's never fun. But if you shop around and you find a lender that is not going to sell your loan to Freddie or Fannie Mae, then those fees don't apply. So do your homework, but caveat, don't make too many official mortgage applications, or that will ding your credit, and that may hurt the rate that you're able to get. It's okay to call, ask questions, show them what your credit score is and ask in general terms, but you don't want too many what are known as hard inquiries on your credit before you make an official application. Thanks so much for tuning in. This has been another episode of Better Financial Health in 15 Minutes or Less.